Welcome to The Explainer. Okay, let's dive right into what is arguably the biggest, most mind-bending puzzle in the global economy right now, the wildly entangled web of global borrowing. I know. When we hear terms like global debt, it's super easy to just tune out, right? It feels like abstract math sitting on a dusty government spreadsheet somewhere. But trust me, this isn't just some weird accounting trick. It's actually the ultimate key to understanding how our modern world fundamentally operates. $300 trillion. I mean, just let that sink in for a second. That is the sheer, mind-boggling scale of our total global debt. To put that into perspective for you, it's more than triple the size of the entire global economy. Literally every bit of value created, every product manufactured, every single service rendered on planet Earth in a whole year, and our collective debt triples it. It's a number so large it almost doesn't feel real.
So let's try to visualize it. Imagine a stack of $1 million in crisp bills. That's roughly the height of a 30-story building. Pretty tall, right? Now, $1 billion, that stack reaches all the way up into the Earth's atmosphere. But $300 trillion, that stack of cash goes all the way to the moon and back 50 times. 50! That's the true literal weight of the debt we are looking at today.
Which naturally leads us to a massive elephant in the room kind of question. If every single nation on Earth is taking on these giant loans, who exactly is the ultimate lender? The US alone owes $36 trillion, and China owes over $18 trillion. If everyone is drowning in debt at the exact same time, who's actually holding the bag? Like, who is getting paid?
Here is our roadmap for this explainer. We're going to cover the $300 trillion mystery, take a quick trip through the history of debt, unpack the great debt loop, explain why we simply can't stop borrowing, assess the risks of default, and finally, look at the market's shift to gold.
All right, part one, the $300 trillion mystery and this incredibly complex web of entangled lending.
You know, people constantly point to China as this shadowy figure holding all of America's debt. And sure, they do hold about $750 billion of it, but here's the kicker. China is drowning in its own $18 trillion debt. A huge chunk of that sits with Chinese banks, but those same banks own debt from the US. And American banks? They hold debt from China and Europe. The deeper you look, the more entangled and intertwined this whole system gets. Moving right along to part two. A brief history of debt and how we went from localized trust to fiat currency.
To understand this, we really have to look back. Long before banks or paper money, debt was just a simple promise between neighbors based on trust. You borrow grain in the spring, you repay it at the harvest. By the 1600s, things leveled up when King Charles II started issuing public bonds to fund a war without raising taxes. Fast forward to 1944, the Bretton Woods Agreement tied the US dollar to physical gold. But by 1971, to keep up with massive government spending, President Nixon severed that tie entirely, completely ending the gold standard. That 1971 shift to fiat currency? An absolute game changer. Shifting to fiat basically meant money was no longer backed by a physical asset like gold, but purely by government decree. From the 1980s onward, global debt absolutely exploded. Governments realized that limitless borrowing wasn't just for fighting wars anymore. It was a magic wand to build schools, repair roads, and pull economies out of recessions. Debt totally stopped being a last resort and transformed into the standard operating procedure for the modern world.
Which brings us to part three, the great debt loop. Think circles here, folks, not straight lines. Okay, let's just bust a persistent myth right now. The world's most indebted country, the US, actually owes roughly 70% of its debt to its own citizens and domestic institutions. Essentially, America is borrowing from itself. Modern debt doesn't move in a straight line from point A to point B. It moves in a giant circle. So here's how this crazy loop actually plays out in real life. You deposit your hard-earned savings into a local bank, right? Well, it doesn't just sit there gathering dust. The bank uses your money to buy government bonds. Then the government spends that money in the economy and pays back interest. That interest flows right back into your bank, giving the lender even more spare cash, which they then use to buy, you guessed it, more bonds. It's a continuous, self-reinforcing loop, with a 10-year US bond currently paying out a very safe, guaranteed 4.5%. And this entire engine is powered by a massive, hidden network using your money. We're talking commercial banks currently sitting on nearly $1.8 trillion in US Treasury bonds. That's triple the GDP of a country like Brazil. Pension funds invest a solid 25% of all their money into these bonds, and insurance companies place over 60% of their assets into them. It's just a constant flow of money moving from where it's sitting idle to where it's being spent, constantly feeding the cycle.
So on to part 4, why we can't stop. The undeniable growth engine. You might be wondering, well, if it's all just a circular loop, why don't we just stop, hit the brakes, balance the books, and be done with it? Well, the uncomfortable truth is that borrowing is literally the fuel for our growth. Right now, debt funds 1 in 4 U.S. government dollars, which is equal to what they spend on education and welfare combined. Over in China, it's 19% of their spending. If you stop the borrowing, the money simply stops flowing. Businesses earn less, workers lose their jobs, spending dries up, and the whole economy violently contracts.
And we've actually seen what happens when you do slam on those brakes. Just look at Greece back in 2008 when they lost their ability to borrow. The result was devastating. Wages plummeted by 30%, and their entire GDP shrank by a quarter. Compare that to the US in 2020 during the COVID shutdowns. To survive, the US government borrowed a jaw-dropping $3.8 trillion in a single year just to keep the economy afloat. Borrowing isn't just about expansion anymore. Sometimes it's literally about pure survival.
All right, part 5, the risks of default. Let's look at the fragility of this entire system. Because let's be real, paying off an old credit card by simply opening a new credit card, it raises a very uncomfortable question. Can the cycle really spin forever without some severe consequences? The most immediate risk is an extreme inflation spiral. When borrowing costs jump, the classic government band-aid is to just print more money. But doing that completely dilutes the value of the currency. Just look at Venezuela in the late 2010s. They printed so much money to cover debts that prices doubled every few weeks. A simple loaf of bread cost millions of bolivars, and ordinary people literally watched their life savings vanish overnight.
Now, for developing nations that have to borrow in foreign currencies, a weakening local currency makes paying back that debt practically impossible. Lenders start demanding higher interest rates, and eventually, the country has no choice but to throw its hands up and say, "We just can't pay." That is a sovereign default. It completely severs them from all future borrowing and risks a catastrophic bottom-up collapse of their entire economy.
Finally, let's jump into part 6, the shift to gold, and how the market is actively reacting to all of this.
So, what happens when a system built entirely on paper debt starts showing some pretty major cracks? Investors start scrambling for something real. With trust in fiat currency proving to be super fragile lately, gold is already up nearly 28% in 2025 alone, while the US dollar has dropped 9% to a 3-year low. Silver just hit a 30-year high, and mining stocks are up nearly 45%. And the major institutions are definitely taking notice. Massive banks like JP Morgan and Goldman Sachs are now forecasting gold could hit $4,000 an ounce by 2026.
If you want to see exactly how the market is pivoting right now, Gold Mining Inc., ticker symbol GLDG, is a really fascinating case study. What's wild here is the sheer disparity in their valuation. Their portfolio of publicly traded equity holdings actually surpasses $150 million. Think about that. That holding alone is worth more than the entire current market capitalization of the company itself, and that's before you even account for their actual physical gold projects or the cash they have on hand.
And those underlying projects are substantial for sure. They have an estimated 12.4 million ounces of measured and indicated gold equivalent spread across the Americas, plus about 6.8 million in cash. Because the massive legacy mining companies are facing a really severe challenge in replacing their dwindling reserves right now, resource stage portfolios like GLDG are drawing heavy institutional backing from financial heavyweights like BlackRock, Morgan Stanley, and Goldman Sachs, who are all clearly looking to secure physical assets.
So here's the ultimate takeaway for this explainer. We are all currently strapped into this completely unprecedented $300 trillion debt cycle, a cycle that relies entirely on borrowing from tomorrow to pay for today, over and over again. As this loop inevitably spins faster and faster, is returning to the physical, tangible assets we abandoned back in 1971 the only real way to anchor our economic future? It's a massive, critical question, and it's exactly why understanding this incredible global web of debt is absolutely vital for all of us.